welcome guys. So let's look at this week macro outlook from MacroLabFX and what we have for the week from fundamental perspective. So we hope that this video helps you to make better decisions, know what the market is saying, and how you can perhaps position yourself properly. So here is we're looking at our executives. We're looking at week the week, I think the third week, which is from 17-21 August 2026. And from our cover page, you could see that we have from sub data to forward inflation risk. Our monthly regime is restrictive Fed with rising forward inflation risk. We can also look at weekly trading regime, which is expectation driven macro. So we expect the market to, be driven by expectations based off from some of the data we gathered and the research, we have on our weekly outlook. So as we proceed, we will explain that more and more efficiently. So if you want to get the full research of want to get the file for this, look out for it on our LinkedIn page. You can always get that on our LinkedIn page. All right, so this is primary driver is our July FOMC minutes, and of course our highest risk is the FOMC minutes of Wednesday 19th, and we're seeing USD to still remain constructive bullish. We're seeing USD still bearish. We're seeing pound USD to be bearish, neutral bearish. We're seeing gold to still stay bullish, right? But this is just from our asset outlook. Weekly bias is just more of it. We need data to confirm all of this. So let's look at our executive summary, which is one of its kind. Just a quick one. Last week, we could see that last week we have the US CPI data. We have a lot of domestic data coming from the US, from consumer price index to producer price index, then retail sales. And all of those data made up to what we see the market did last week. Those data were quite not so supportive for USD, and that's why you could see Euro USD rallied, Pound USD, rallied, at the later part of the week. So the US economy generally is slowing down, but it's not that aggressive, and that's because we have some underlying factors which the markets, need to see to really price in a dovish, monetary policy of dovish expectation. So the market is still dangling, trying to see breakout fully to be a bearish USD, but it's building up because the data, the macroeconomic data, fundamental data are supporting it, but expectation data is still not, fully supporting the buyers. And that's why you could see we have two opposing macro forces. For the dovish development, we're seeing softer labor market, moderating CPI, softer CPI, weak retail sales. We're seeing slowing domestic demand. Of course, that should support the USD sell. But on the other side, oil is still high. We're seeing the geopolitical tension still coming in. We're seeing forward inflation risk. We're seeing Federal Reserve still staying a little bit restrictive because some of these data are just one print, so it has not really justified more dovish outlook coming from the Federal Reserve perspective. Okay, so let's look at what matters most this week. What matters most this week, as usual, is one of our core fundamental of our outlook. Now, the market appears to be assigning greater weight to hawkish development. Now, the question we want to ask. The first question I want to ask is, now, will FOMC minutes reinforce higher for longer? Now, that's the question we want to see, if FOMC will reinforce a higher for longer perspective or give us a clue that the Fed is now more relaxed to, ease ease monetary policy and all of that, or they still need to wait for more data to come in. Now, the question two is flash PMIs, and the third question is the oil. The oil, with oil keep on reshaping inflation expectations. So that's a key question we want to ask ourselves. Will oil reshape monetary policy going forward, or sorry, inflation expectations? So what we have from our perspective, from MacroLab view perspective. Now, our structural monthly outlook remains constructive in the USD space, right? Remain constructive in the USD space. So we are looking at constructive for USD, and if you look at it, but the reason as involved, previous the dollar was supported by strong labor, sticky inflation, higher yields, sale of that. Today, the support comes from Fed policy credibility, which is coming from forward inflation risk, right? This is where I want you guys to pay attention, right? Now, the reason we have not had that sharp breakout, which I'm expecting, is because market is looking at the forward inflation risk, being that the August data, the July data did not price in the resurfaced increase in oil prices. Okay, so if market get the August data in September, we want to see if the increase in oil prices is actually finding expression into inflation, and of course, if labor data will resurface to become stronger. So all of those things plays a greater role to what we want to see. So, but generally, the US economy is actually slowing down. That's honest truth. It's slowing down, but we need to see more data to, confirm, all of that. So that will give us, a view of what we want to, see. So let's look at the first slide, which is one of our most important parts. The weekly institutional positioning still maintains that the weekly regime is still restrictive Fed with rising forward inflation risk. Our primary driver this week is going to be FOMC Minutes. Our secondary driver is going to be oil prices and Treasury yields. We want to focus on September Fed expectation. That's what the market is focusing on. Our trading style will be expectation-driven macro. Our preferred strategy will be buy USD on confirmation. Our highest risk event we'll have for this week is FOMC Minutes, which is on Wednesday, and our weekly conviction about 8.4. And look what it is. So if you're going to build on this, you're going to, although we are still USD bullish, still bearish, which is if you look at this, and I think in slide 2, we have Doge development and hawkish development. So we saying that we are still bearish on Euro USD is constructive. It's constructive, right? So do not see it as, do not take it from a place of isolation. You need to confirm from your technical perspective. You need to confirm from your market sentiment, and build on that. So our weekly market scorecard, which is our MacroLabFX model dashboard, still tells us what the market is doing and what we intend to do from the monetary perspective. So let's look at the macro regime monitor, which is one of our core macro regime monitor, one of our core highlight, or one of our core backbone when we are building our weekly outlook. Now, if you look at the US macro regime, or looking at some economic data, you see that growth is cooling down, right? The trend is lower. USD impact is bearish. You can see inflation is moderating. You can see the trend is lower. Labor's weakening, lower. Monetary policy still restrictive, is stable, is bullish. Then we have our forward inflation risk, which of course we are looking into September, is rising because oil prices rised again. So it's higher and it's bullish for USD. Financial conditions is still restrictive. It's bullish for USD. Geopolitics is still elevated, which is the US-Iran war. It's still very much elevated. It's not a win. We don't have any win yet, so the risk is still there. The trend is higher, and the USD part is bullish, right? Our regime transition is regime transition monitor, which of course we use to gauge where we are before and where we are going. All right. So growth is resilient previous week, but this week is cooling off. Labor is cooling off. This week is weakening. Fed bias is restrictive and it's still restrictive. Market narrative is still data driven. This week is expectation driven. Overall regime is still higher for longer, which is still under review. Then this week we're looking at restrictive Fed with rising forward inflation risk. So I want us to look at slide 11, right? Because that gives us a view of the yield dashboard. Now it gives us the yield, give us a view of the yield dashboard we've built and how we see the yield market. Because the yield gives us a view of where, long term, give us a view of expectations, really, right? So that's why we cannot take out looking at the treasury yield and seeing how the treasury market, is responding to current economic data and all of that. So that being said, you could see that we have the US 2-year yield is still stable. The US 10-year yield is rising, is bullish for USD as well. The real is elevated, is bullish. Then the yield curve is gradually steepening, which is neutral bullish, right? So all of this tells us that the yield market is still elevated. The 2-year yield is still above 4.0. 10-year yield is still above, rising there. So the yield bond market is telling us something different. The economic data is telling us different because from expectation, the bond market has not fully repriced a dovish Fed. Now, let's look at some yield confirmation matrix. Hawkish FOMC minutes will see a higher 2-year yield. That will be bullish for Euro USD, bullish for US, sorry, and bearish for Euro USD, bearish for Euro USD. If the minute is neutral, 2-year will stay stable, USD will stay neutral, then we expect range markets from both Euro US and Pound USD. Then flash PMIs and what it costs for the Euro USD and Pound USD. Let's look at our weekly economic data, which is quite important. So we don't have much US data this week other than the FOMC minutes on Wednesday, and which is by 2 p.m. Eastern time. Then we'll have our flash PMI on Friday, which of course will give us a view of what is going on around business activity across the G3 economy. So on that part, I want us to look at is our weekly outlook on Euro USD. Euro USD is we tagged it Serral is into resistance, right? And being that hawkish minutes will mean a strong bearish, dovish minutes will be bullish. If we have higher oil prices, it's going to be bearish, right? Big PMIs is going to be bullish for that. So it's really just we still looking at the market and knowing what sentiment are saying for the week. Remember, this is August, so caution is applied. Same thing for Pound USD. You could look up that. Then the last part I want us to look into is the our conclusion, right? Which is the theme one is slowing domestic economy, restrict Fed and rising forward inflation risk, right? So this we have the first thing, which is slowing economy, soft labor, cooling inflation, weak consumer demand. This will normally argue for a weak dollar. Yeah, the team should argue for a weak dollar because the data is supporting that we should sell dollar. Yes, and buy Euro US and Pound USD. But expectation is saying something different. So we'll buy dollar, we'll sell dollar, buy Euro USD or at key levels, right? And sell Euro USD also at key levels. Maintaining a caution approach, until perhaps we'll see what is going on. So Our final investment framework is traded by constructive US dollar. We're seeing, we're also seeing trade confirmation rather than implication and all of that. So for me, it's just we staying on that playbook, and of course seeing what the market is doing, and we'll take it off from there. So this is what I expect us to know, and we'll build on that. So if you can take up this report and do your own assignment, see how it could help you to um, make an informed decision. And of course, we'll see you keep making progress. Bye for now.